And that is the very question I want to start this conversation with. Company specific, or is it really a sign of the times? And does it speak to rising risk in a market right now?
Well, I mean, I do think it shows a rising risk in the marketplace. But at the same time, I don't want to start, warning that, geez, this is another 2008 all over again. Mm-hmm. We saw what happened today in the market. The market acted just fine in the news with Silvergate. I'm a little bit more surprised that the market's not paying a little bit more attention to what's going on with Credit Suisse because of the derivatives, and we have counterparty issues there. So, I mean, I guess my point is, if things really start to get much worse there, that can have broader implications. But thankfully, we don't have the same kind of leverage in the banking system that we had in 2007, 2008. So again, a bigger fear, but not something where we have to worry about staring into the abyss like we did a dozen years ago.
The fact that we did see the markets here, the broader averages, rally into the afternoon and perceived, to channel Steve Leisman here, perceived maybe slightly more dovish talk, whether it was in fact more dovish or not, from Bostic at the Atlanta Fed. Your take on the dynamics we've been seeing in stocks and what's priced into this market?
Yeah, I mean, I agreed with what Steve had said earlier about I didn't see it as much as dovish as maybe the market saw it. And the one thing I guess that really concerns me on a intermediate term basis is what we're hearing from most of the Fed. I mean, we're hearing say, well, we we're not worried about the stock market, and recessions are certainly possible. And I guess what comes that I'm concerned about with the way investors look at it is the investors think, they seem to think it's like, the Fed's job is to make sure we don't have a recession. Now, that's not it. I mean, if you listen to what they've said, especially in the last week or so, it's like they are determined to beat inflation. And, that's really the more important thing. I mean, the Fed knows that recessions are not extinct. They're going to happen. Bear markets are going to happen. And if they need to beat inflation, they, I think, are telling us that they're going to risk, even if it's just a mild recession, doing that. So I guess my concern is that with interest rates rising the way they have been again and broken above all sorts of trend lines, we have earnings estimates coming down. That's not the kind of recipe that really bodes well for a further rally in the market, at least not right now.
And of course, we've had another busy hour in terms of earnings results. Given what we've been hearing in this earnings season, do you see opportunities right now to buy in?
Well, I mean, there's always opportunities in individual stocks. It'd be interesting to see what happens with Broadcom. The stock last I saw was about unchanged. And you'd like to see after NVIDIA's a real good number, their number was pretty good. And then, of course, they mentioned AI 500 times in their conference call. So maybe Broadcom will do the same thing and help the stock rally. But my point is that earnings estimates are coming down. We saw, I think it was Credit Suisse today, lowered their earnings estimates for the year. And I guess my point is, I think one of the sectors that people should be looking at certain sectors and individual names. And one of them that I like is of course, one that you follow so closely is the defense and aerospace area, where the world is not becoming a safer place. And all that stuff about cutting defense spending that we heard in early January, I think that's gone by the wayside. So people should take a look at some of those areas as well.
Okay. Matt Maley, thank you.